Hey everyone, thanks for joining me for the Spring 2025 market commentary. I always enjoy putting these updates together, and I hope you enjoy watching and listening to them as much as we enjoy putting them together. The reasons that we put this together are one, just to kind of understand what's happening in the markets, why we're making the decisions that we're making, and how these decisions fit into your long-term goals. So with that, I'm going to start with a slide that if you've seen me do these before, you've probably seen this slide. It's just an updated one here. But if I'm using it again, it's because I think it's important. If there's one thing that continues to surprise investors year over year, it's volatility. This chart here is looking at the S&P 500 over the last 45 years. So it's looking from 1980 to, you can't see it because my head's in the way over here, but through the end of February 2025. And what you'll see here is if you average out all of the red data points down here, these are all the intra-year declines. So from a market peak to a market trough, what's the largest declines that occurred in every single year? If you averaged those out, what you'd find is that the average intra-year decline is at 14% referenced right there. Now, the data I'm using here is, like I said, is only through the end of February of 25. So it's not capturing everything that's occurred as you're watching this here. This is showing larger, the year-to-date intra-year decline of being -5. It's actually closer to -10%, and this is closer to a -5% as we sit today here as I'm recording this at the beginning of April. So anyways, the reason I highlight this here is that it is normal for the markets to have declines in any given year. For the markets to decline 10% like we sit today, that is totally normal. If you look back over the last several years here, you're going to find obviously most years you have a decline that's greater than 10%, even in years where you have large positives. But amidst all of that, as it highlights here, 34 out of 45 years, you end up with positive returns. So I want to change gears here. We're going to talk about two very specific things here. One, valuations. And these two topics are a little more narrow to what specifically some of the headlines that you may be seeing. Valuations, and specifically like Magnificent Seven stock, Mag 7 stocks, Magnificent Seven. And then the others is tariffs. I'm sure me saying tariff, it's probably the first time you've heard the word tariff this year. Not. So let's talk about valuations first. So one of the key factors in determining a long-term investment return is valuation. I think one of the most compelling lessons in market history is that over long periods of time, value stocks tend to outperform growth stocks. And the reason why that is because value stocks, kind of like they sound, they are, all else the same. It's like they're priced, they're cheaper for their earnings. For the metrics often used is price to earnings ratio. So they have a lower price to earnings ratio. Often, if I talk about it with you in person, I usually say, hey, if you were buying a restaurant from somebody and they said, hey, we're going to sell you the restaurant for 2 times our profit, 2 times our earnings, and you go buy another restaurant and you had to pay 5 times earnings, well, the other one is more expensive, right? That's what value investing is we're buying stocks at a cheaper multiple compared to their earnings. And that's why value stocks have outperformed growth over a long period of time. That's what this chart is showing you here. The gray on top is showing periods of time where value stocks have outperformed growth, and then the yellow down below is showing you periods of time where growth has outperformed value. The period of time that I'd like to highlight here is this window right here. Again, yellow means outperformance by growth, gray means outperformance by value. As humans, we are often subject to kind of a recency bias. We like to think that we're objective characters, but we're often not, right? And even when I show you a chart like this, you go, okay, that doesn't feel accurate though, Matt. And the reason it doesn't feel accurate is because the last 10, 15 years, it's not been accurate. US large growth stocks, particularly like the tech giants like Apple, Microsoft, Amazon, Nvidia, Google, have really dominated market performance. And you've seen, as I'm showing here, periods of time where growth has outperformed value stock. And what I'm telling you has not been true for the last 10, 15 years. But do we think that this premium, where we've seen over the last 100 years, we've seen almost 4% annual premium in value stock relative to growth, do we think that that's going to persist over the long term? And the answer is yeah, we think that is going to be true. Even though that's not been true for the majority of the last 10 or 15 years, do we think that's going to be true over the long term? Yes, we do. The other thing I'd like to highlight here is that the concentration of those large stocks, the Mag 7 stocks, Facebook, Amazon, Nvidia, Google, those ones, Tesla, those make up a large portion of the U.S. market cap. And you saw a little bit of a scare there in February where Nvidia kind of had a shakeup because they had a competitor from China that had created some of the AI technology at a deep discount to the way that some of the U.S. Companies had, and it took away $600 billion in market cap from Nvidia, almost overnight. Now that's not me to say that, hey, we think Nvidia is a bad company and that they're gonna fold or anything like that. But that's why we don't want to have such a large concentration in one individual company, and why we still think that even amid all this, diversification matters, valuation matters. So with that, I'm going to change gears into talking a little bit about tariffs. Again, like I kid before, this has been the major headline of 2025 has been tariffs. And many investors, if you can remember back to the market's reactions during Trump's first administration, when tariffs and trade wars were at the major forefront, these three charts, these three lines here, are looking at China's performance, the U.S.'s performance, and then the developed markets, not counting U.S. Performance during Trump's first term. And what you see there is that, yes, there was different ebbs and flows to the markets, based on different things that were occurring around the trade tensions for the U.S. and China specifically. But even amidst that, the long-term impact on the market was minimal, and the U.S. And China both outperformed relative to their global international stock counterparts. The other piece that I wanted to highlight here as it relates to tariffs, and I think this is maybe more of the real concern that I've heard expressed both from clients and then maybe just from clients, from people that I've talked to around this. This is the concern that I have heard is fear of inflation, right? And when I hear inflation, I often remind, and I've probably, if you've asked me about it, I remind our clients that the best long-term hedge against inflation isn't gold or precious metals, it's stocks, right? However, the real fear arises when we talk about stagflation, where GDP declines while inflation rises. Now, historically, this is what this chart is looking at here. There have been 12 periods of stagflation since 1930. So over nearly the last 100 years, we had about 12 periods of stagflation where we've had negative GDP and positive inflation. In those 12 periods, 9 out of those 12 periods, US stock market returns still beat inflation. So 3 out of those 12, you had a negative real return, right? And I'd like to remind you that's when we seek to invest, this is like a humongous investment principle. The core of why you invest is so that your dollars outperform inflation, right? If you're saying, hey, I'm going to go invest in, you go put the money in a CD or in a bank account, and yeah, it's going to earn 1, 2, 3, 4%. But if you factor in inflation, you're losing purchasing power in real dollars. So our ultimate metric of success in investing is our purchasing power increasing over time. So anyway, sorry, went on a small tangent there. But 9 out of 12 periods of those periods of stagflation, you still had you had the U.S. market outperformed even with the higher inflation. So that's a success rate of say 75% there, which is remarkably close to the long-term trend of markets delivering positive real returns in 68% of those years. If you come into the office, sometimes you'll see me bust out the big matrix book with all the fancy data on it here. This one here, obviously there's no shot of you being able to see the numbers on this, but this shows the S&P 500 in inflation adjusted numbers, which I think is quite valuable to look at there. And if you look at the 94 years, from 1930 through 2024, you have 30 out of 94 years. You had a negative, 30 out of 94 years, you had a negative real return. Inversely, 64 out of those 94, you had a positive real return, which is what we're seeking. So anyways, I think that's, again, just valuable to provide proper framing, and hey, what reaction should we have as investors when we look at what's going on in the markets? The last thing that I wanted to address is kind of the current market sentiment and how it's evolved so far this year. So this chart here, they measure investor sentiment towards the markets. Hey, do you have a bearish sentiment? Bearish meaning, hey, do you view the markets to be pessimistic over the next 6 months, or optimistic over the next 6 months? The long-term average is right around this 31% here. So if like right now, the data that I'm citing here is from February here, but the sentiment was around 37%. So above, over, I guess right here, right? 37%, which would be above the 6-month average return, above the normal sentiment, right? So more people think that the markets are going to underperform over the next 6 months than is average. And during those periods of time, the markets do about 6.2% over the following 6 months on average, right? Inversely, if people have below average bearish levels, the markets actually do less. So you might look at a chart like this and go, well, Matt, why do we care about what their sentiment is towards things? And I would reply, that's an astute observation. Why do we care? So anyways, it's just a reminder that the smartest people, that the people that speak on this all the time, financial media, they are wrong all the time, right? And their objective is not to be objective to you. Their objective is for you to watch their programming, to read their articles and things like that. And anyways, hopefully that helps. But really, I think the main takeaway is don't let fear drive your decisions. Historically, markets have rewarded disciplined investors who stay focused on the fundamentals. So I think with that I'll conclude. conclude our spring 2025 market commentary. I look forward to seeing you here in the next days or weeks. And if you have any other questions that you want to get into on anything I talked about in here, please let me know. Or if there's anything else that I didn't talk about that you want to make sure that we address, please let me know. Thanks for listening. It's a privilege to serve you. We'll talk to you soon.